Hello, folks. This is George Almodovar, realtor, real estate investor, and author of The No BS in Making Millions in Real Estate. Today's topic is steps to take before buying a house. Now, I want you to think about this carefully because buying a house is the greatest and biggest investment you will ever make in your lifetime. It's not like buying a car. It's not like buying clothes or going food shopping. There are steps that you need to take to be prepared because based upon the credit score that you may have at the moment you are approved for a loan, that's going to affect you from 15 to 30 years ahead depending on the term of the loan. So you want to make sure you have the best credit score possible so you can get the greatest and best interest rate, thus reducing compounding interest. And that could add up to hundreds of thousands, if not at least tens of thousands of dollars. So the first thing you want to be aware is your credit score. How high is your credit score? You want to have a good credit score, just to give you an idea, is about 680. You want to have about 720 and above to have a great or excellent credit score. That gives you the best rates available in the market. The second step you want to do, okay, is you want to make sure what is your down payment. And the reason I say that, although you can obtain an FHA loan with a 3.5% down payment, remember the more you put down, the less you're going to pay in mortgage throughout the term of the loan. So you want to minimize the term. Now, in my opinion, as a real estate investor, I believe in other people's money. So I'd rather put down as little as possible as long as I'm able to pay the monthly mortgage payments. Now, you may think differently. You may want to put as much as possible because you want a low mortgage payment every month. That being said, I'd rather get a term of 30 years. If they even offer me 40 years, I'd rather take that than 15 years. Although sometimes you get a lower interest rate. Now, the reason I state that is because if I have a term for 30 years, my mortgage payments are normally smaller than it is for 15 years. Now, why is that important for me as a real estate investor? Because if I ever have to relocate, rent the property, I want to make sure that the rental income I will get from that property will cover my expenses. That's as a real estate investor. You as a homeowner may want to consider, if you have a spouse and you depend on your spouse to pay the mortgage payments, and one of you happens to lose a job, okay, it becomes harder to make that mortgage payment if you took it for 15 years. Thus, it doesn't matter whether you pay 10 years on that mortgage, you still have 5 years to pay. So if you lost your job and you can't pay that mortgage payment, you could end up being in foreclosure and losing that property. Okay, and by the way, even if you do lose your job and you're trying to refinance, you can't get refinanced because you have no income. So this is why you want to minimize that mortgage payment. So I'd rather take it for 30 years, and what I do is make monthly payments, and if I have extra funds, I apply it towards the principal, extra funds, thus reducing the term of the loan and reducing compounding interest. But if things hits the fan, I have a lower monthly mortgage payment, so less responsibility or less something to worry about, that I know I could make it easier for me to make that payment. So think about that. So one, again, you want to make sure your credit is above 680. Two, you want to make sure what you have as a down payment, what you're willing to commit. Three is your income. As I stated in another video, although you can obtain an FHA loan as well as there are other loans such as Fannie Mae and Freddie Mac, the income is important because based on your gross income, 31% of that gross income is what qualifies you for the mortgage. That's the first thing they look at. One of the factors that they look at. Okay, so 31% of your income qualifies you for that mortgage. That gives you a rough idea of what you can afford as far as the mortgage payment. The second thing banks look at is called the rear end or the back end, which happens to do it based on your gross income. You cannot exceed 50% of your gross income in debts. So when you combine the mortgage, which is 31%, which is petty, principal, interest, taxes, and insurance, you're also going to look at the minimum payment of all your debt. Credit cards, minimum payment, your installment loan, student loan, all these is taken into account. It cannot exceed 50% of your total gross income. Okay, so the bank is going to require your monthly gross income. So in other words, your recent pay stubs. They're also going to require 2 years of your tax returns. So make sure you have that available. Another thing you want to make sure before even looking at a property, you want to know what you are approved for. You don't want to start looking at great, beautiful properties and you like it because they are more luxurious, they're more expensive, but then you don't qualify for it. And then when you look at a inexpensive property, you may not like it. So my point is, make sure before you even decide to look at properties, you are already pre-approved. So when you do call a realtor such as myself to assist you, it's very easy for me. I know what you qualify for. I know what properties to show you according to the range that you qualify and what you're looking for, what description of the property, whether it's 3 bedrooms, 4 bedrooms, etc., etc. So I hope this helps. If you need more information, view my other videos as far as how to qualify for real estate with low income or no money at all out of your pocket. Also, how to improve your credit score. Okay, you can also view me online at www.familyhomesforsale.com. Once again, familyhomesforsale.com. I hope this helped. Any information, log online and input comments below. Thank you very much. Have a blessed day. Bye-bye.